Welcome to our webinar entitled Navigating New York Electric Market Volatility, Spring Insights, Grid Challenges, and Risk Management Strategies. My name is Mark Levine. I am the Deputy Director of your New York State Association of Counties, and I'm the Executive Director of the Municipal Electric and Gas Alliance. MEGA was created by Tompkins and Tioga counties 27 years ago, and we currently serve 31 counties among the 250 local governments and school districts and special districts that we serve across the state of New York. Today's webinar will break down the significant electric price volatility experienced in late January and early February, driven by an extreme deep freeze and growing stress on the electric grid. We will also cover some of the more recent global activities that are impacting energy prices across the world. Constellation's New York market expert will walk through the underlying supply and demand dynamics, the rising cost of non-energy components, and the anatomy behind recent New York ISO index price spikes. This session will also explore the increasing challenges of maintaining grid reliability, why volatility is becoming the new norm, and practical electric price risk management strategies that our customers can use to navigate today's market environment with more confidence. Before we begin, we have a few housekeeping announcements. Jeanette Stanziano is NYISO's Director of Education and Training. Jeanette, thanks for running this webinar today.
My pleasure, Mark, and welcome everybody to this morning's webinar. Just a couple of housekeeping measures to make the process for the webinar seamless for you. We are recording this webinar, as we do with all NYSEC webinars, and we will be posting it on the NYSEC website directly following the webinar, about a half an hour afterwards. We also encourage you at any time to feel free to submit any questions during the presentation. The way we ask you to submit them is by referring to your dashboard, clicking on the Questions tab, and typing in your question on the dashboard. We will then address your questions at the end of the presentation during the Q&A. We will be sending you on the day after this webinar a link to both the recording and a PDF of today's slides. Enjoy this webinar, and back to you, Mark.
Thank you, Jeanette. Constellation Energy won the bid with MEGA for the electric supply for MEGA members across the state of New York. Constellation Energy is also the preeminent expert in energy in New York State and beyond. So we want to welcome two speakers today from Constellation Energy. Britt Lyons is a principal in the Commodities Management Group for Constellation, where she delivers power and gas market and regulatory analytics, innovative deal structures, and execution strategies to educate and assist customers with energy procurement and sustainability solutions. Britt supports deals spanning ISOs nationally, where Constellation does business with a focus on our hourly carbon-free energy business. Britt joined the company in 2006 and has held a variety of roles within the company's retail business. Prior to her current position, she sat on the retail pricing desk, supported special projects for M&A, and worked in various operational roles within the organization. She is a Pennsylvania native, but has spent time living and working in Baltimore, Houston, and New York City offices. She is a graduate of the University of Pittsburgh and currently resides with her family in Philadelphia, PA. Dan Murphy is a business development manager for Constellation, who uses his expertise and skills to assist direct customers and consultants with their energy-related activities. Dan is a preeminent BDM for the MEGA program. As an experienced energy specialist with over 30 years of work in energy and business development in both a regulated utility environment and within an energy services company. Dan has an exceptionally broad background that spans the entire energy spectrum from generation and distribution to pricing, energy efficiency, and alternative energy. He holds a Master's of Business Administration from SU and a BS in Geography, Urban and Regional Planning from the State University of New York at Oneonta. He also holds several notable certifications, including Certified Sustainable Development Professional and Certified Business Energy Professional. Please join me in welcoming Britt and Dan to today's webinar. Britt, it's my honor now to turn the reins over to you.
Thanks, Mark. I appreciate it. Let's see if we can flip it over to the presentation.
Yep, this is it. Yep, perfect.
Okay. All right. So thanks so much. I appreciate it, and I'm happy to have the opportunity to be here today and talk a little bit about, what's driving electricity prices in New York State. So very high level, your electric charges fall into two main categories: supply and distribution charges, which you can, see in that far bar chart to the left. Each make up about half of your total energy costs, but obviously that percent can shift around a little bit based on the market and where actual energy costs are at any given point in time. But today we're going to focus on the supply side. So what you see, represented in the bar chart by Constellation, that's a category that would fall under your Constellation contract. And in the pie chart, in the middle here, you can see the various cost components that make up your supply charges. The largest of those, represented here in blue, being your actual energy costs, and then some, smaller components such as capacity, ancillaries, transmission project costs, and costs that are associated with the Clean Energy Standard and the Climate Leadership and Community Protection Act, or CLCPA, in New York. If we look at the two charts on the right-hand side here, you can see just kind of a snapshot view of what prices have been doing, going back 5 years. So each of these looks at a 24-month forward fixed price, including the components that you see in that pie chart in the middle there. And so this can kind of show, the history going back to 2021 of how those costs have kind of moved over time. What you'll see here is that, generally we've seen costs kind of on an uptick. And again, we're going to talk about some of the factors that are driving that today. So the next slide that we have here is just a high level overview of fundamentally what some of these drivers are. The first of which is natural gas price volatility. So a large part of the generation mix in New York State comes from natural gas fired generation resources. And so electricity prices are closely tied to gas prices in New York. And those have been pretty volatile in recent years. The chart you see on the right-hand side here comes from a recent New York ISO, that's the grid operator for New York State, a recent white paper that they published. And it kind of shows, the natural gas and electricity price volatility going back to 2019, with prices hitting near record lows in 2020 due to the pandemic. Then we saw prices kind of run up and hit near record highs as we saw economic recovery after that, demand rebuilt, and also global tensions fueled demand for US LNG. So we'll talk a little bit more about that and how that's sort of reemerged as a theme here. And then in 2025, we saw electric gas prices about 120% higher than in 2024, about an 80% increase for electricity prices in 2025 versus 2024. You know, again, kind of all surrounded to this tightening supply and demand issue that we're having, really in the United States as a whole, but also and more specifically for today's conversation in New York State. So some of the reasons for that is, you know, like I said, we rely on natural gas for generation, electricity generation in New York State. In recent years, we've seen US LNG demand, you know, kind of catapult given economics, as well as global tensions. And then more specifically to power, you know, we've seen AI and policy mandates push electric demand forecasts higher. There's expectations for large load interconnections, you know, the need for electrification of building and transportation sectors, and some of the public policy mandates, you know, at the state level continue to kind of push demand forecasts higher. Additionally, at the same time as we see load growth projected, we've seen infrastructure retirements outpace, you know, the build of new generation. So since 2019, according to the New York ISO's 2025 Power Trends report, there's been about 4,300 megawatts of capacity that's left the grid, but only about 2,275 megawatts that were added, and most of which are renewables. We'll look at that in a little bit more detail. And then just generally, New York's generation fleet is one of the older fleets in the country, and requires, you know, some updated transmission infrastructure. So we'll talk a little bit more about that. And then finally, you know, obviously weather has an impact on what's happening with prices, especially in the near term. This winter, as Mark mentioned, we saw some, you know, cold that really did have an impact on gas and electricity prices in New York. This winter really will be remembered as the East Coast winter. We saw a pattern, you know, dominated by colder air in the east, which you can see in that map on the lower left-hand side, or right-hand side rather. You know, and that really had an impact on prices. We'll look at the impact of that in some price charts further in the presentation. But all that is to say, you know, we did see some cold this winter, but this winter generally ranked as the 25th coldest out of the last 76 winters from a, you know, lower 48 perspective. For the East Coast, this was the 22nd coldest winter on record. So not even a top 10 coldest winter on record. And we really did see some substantial, you know, price spikes related to things. And so again, it's some of these other factors that are also being very supportive of prices. Moving forward, peak seasons remain a risk. Summer, winter, you know, continue to be where you see a lot of volatility in the state. Okay, moving on to the next slide. I wanted to kind of first focus, in my first 2 or 3 slides, focus on just high level, you know, fundamentals. So both globally and domestically, what is supporting oil and gas prices right now? As I mentioned, there is a correlation between, you know, those prices and electricity prices. So one of the factors here, you know, which is more recent, but really we need to kind of discuss, is the Middle East crisis and how that impacts key infrastructure and transport in that region, and how that could down the line have an impact on, you know, prices domestically for the US, and then eventually in the Northeast and New York specifically. So about 20% of the world's oil and about the same amount of natural gas comes out of facilities that are located in the Persian Gulf. Escalating attacks are targeting energy hubs, and you know, that's what's being shown in the chart here on the left-hand side. A couple of key sort of regional supply hubs, so LNG plants, oil export hubs that have been damaged, and the disruption from those flows are felt immediately, and that damage, you know, for some of those areas can impact prices for years. Again, this map kind of shows details around where some of those issues have taken place. At the same time, Oil and LNG passes through a body of water, which you can see in this map as well. So the Strait of Hormuz, which remains at this point effectively closed. Iran has struck 17 vessels since the start of the war in late February. And those can be really hard to stop because of the methods that they use, like drones and anti-ship cruise missiles, sea mines, you know, and given how narrow and shallow that area is. In recent days, a small number of tankers have been able to move through there, but it's really just been countries that have good relations with Iran. So if you look at the chart on the top right-hand side, you can see the share of global seaborne volumes that are transported through the strait in 2025, and that's very significant. Right now, there's been some assists from Saudi Arabia has a pipeline that's helped to move some of the displaced fuel. But to put this in perspective, right now there's about 9-ish million barrels per day of crude oil that are trapped in the strait. About 5 million barrels a day of other refined products. Again, you can kind of see the breakout of those in the top chart there, and about 10 BCF a day of LNG that's currently shut in. And this has been supportive of both global oil and gas prices, pushing oil prices, up above $100, and pushing, regional domestic oil prices, so WTI, which is in Texas, up to about $93 a barrel as of this morning. This has also created, a pretty big jump in global LNG prices. So we'll look at that in the next slide. So this is overall bullish, but a lot of, how things pan out moving forward is going to be determined on the duration of this conflict and the impact to any other infrastructure in that region. But this is really what's behind kind of the run up in prices in recent weeks. If we move on to the next slide here, this is just kind of an update on LNG. So again, important that we understand from a domestic perspective, what's driving natural gas demand in this country. And the biggest factor really is LNG exports. If you look at the chart, and part of the reason that we care about that is, in the Northeast in particular, we rely on LNG in the winter. So New England competes for cargoes of LNG. So winter prices are especially correlated to, prices for gas globally. And we continue to export more LNG. So currently we're exporting about 17 BCF a day. We can actually, that's just the capacity. We actually have the ability to export more than that because some of these projects can actually produce about 20% more than their capacity. In the next few years, which you can see in the chart on the left in the colorful kind of shaded areas, there's several additional projects that are in commissioning stages with cargoes either expected in coming months or later this year. There's also been several projects recently that have received necessary approvals or announced financing to move projects forward. So a lot of demand growth here. Like I said, about 18 BCF a day was exported this winter. That's expected to be as high as 30 BCF a day by 2030. The events in the Middle East have lifted European gas prices because of the supply issues that I mentioned in the last slide. An ongoing conflict there could further support prices as it forces European and Asian buyers to secure more supply from the US. That can have an upside on prices domestically as well. And so if you look at the chart on the right-hand side here, you can see, the month-over-month change in TTF. So this is the European benchmark for gas, similar to Henry Hub in the United States. And you can see in that blue line how much prices have moved up from a month ago, which is what's represented in that orange line. And finally, and so again, that's kind of overall bullish for prices. And then the last thing I wanted to mention, just, high level, is what's going on with supply domestically, so in the US. So we want to look at, natural gas production as well as underground storage. Right now, as we're moving into, the shoulder season and then eventually summer, we're nearing the end of the withdrawal season. This winter saw the largest weekly withdrawal on record due to some of that cold, but the duration of the cold was insufficient to draw stocks below 5-year average levels. So right now, we're about 10% above year-ago levels in underground storage, about 2.5% above the 5-year average, which you can see in that chart on the left-hand side. This puts us in a pretty good position, through the summer, depending on temperatures and weather. We should start next winter, which is the withdrawal season, above 3.9 TCF, which is above the 5-year average. In terms of gas production, right now for March, we're averaging just under 110 BCF a day. Year to date, we're averaging about 108.5, which is up about 4.5 BCF a day year over year. But I want to really put this in perspective. When we're talking about 110 BCF a day, today we're exporting about 18 BCF of those. Over the next 5 years, we're expected to export, closer to 30 BCF a day. That's really significant. So it's what's the ability of production to kind of keep pace with this demand growth. And in order for that to happen, you'll need to see price support. And then finally, as we see oil prices kind of moving higher, that actually does incentivize more oil drilling domestically, and we can get some associated gas as a byproduct of that. So all in all, from a supply perspective in the US, we're in a good position right now. That's been overall bearish to the market, and that's been keeping a little bit of a lid on domestic gas prices, so Henry Hub prices. But as we kind of move forward into the summer, and depending on how things play out in the Middle East, we could start to see more of an impact where, some of the supply is diverted, or in the winter, you start to see a little bit more of an increase in prices when certain, areas in the US will be competing for LNG. So bearish right now. Long term, we could see some of this flip to be a little bit more bullish for prices. Flipping back to New York specifically, so now that we talked about, globally, what's having an impact on oil and gas prices, as well as domestically, I want to focus more specifically on New York. And so I mentioned that right now in New York, we're seeing demand growth outpacing supply. The couple of charts that I have on this slide come from that report that I mentioned earlier, New York ISO's 2025 power trends. So you can see in the top chart here, how deactivations of generation since 2019 have outpaced additional generation, and the majority of additional generation has been renewables, which are a little bit more intermittent in nature. And then from a demand perspective, you're starting to see artificial intelligence and crypto fueling some data center demand. The interconnection queue in New York has grown from about 1,045 megawatts in 2022 to about 6,000 megawatts as of May of 2025. And one of the factors here that makes it hard to kind of forecast what's going to happen is that there's a little bit of uncertainty around this large load demand. Some of the projects that are in the queue don't necessarily get built. So you can see, looking at the kind of forecast over the next few years where the base load is versus what's expected, and then the potential for additional large load demand, it makes it more difficult for grid operators to kind of forecast what needs to happen with supply, because there's so much uncertainty around demand, and because some of this demand growth is unprecedented. And so this is overall bullish for prices, and is supporting kind of forward prices down the line. The next couple of slides that I wanted to look at have to do with some of the non-energy components. So we're gonna flip back to the energy piece. momentarily and look at some of the price impacts from this winter and where we expect prices moving forward. But I really quick did want to address, some of these non-energy components. So we have capacity, ancillaries, transmission projects, and some of the clean energy standard and CLCPA costs. The first slide I have here is just kind of looking at capacity. I don't want to go into too much detail other than to say that, the fundamentals that I just discussed on the last slide, the fact that we're seeing, retirements outpacing additions in the state is overall supportive for capacity prices in New York State. You can see the price chart here on the lower right-hand side looks at where prices have been, historically going back to 2012. The dotted orange line shows what we're forecasting prices to look like, in the next 12 or so months. And so again, support here as you kind of navigate the changing generation landscape. Simultaneously, you have the New York ISO right now, doing kind of what it's calling the capacity market structure review, similar to some neighboring regions, PJM, New England going through similar efforts. And that's really being prioritized in 2026 to find areas for potential market improvement. So they're looking at things like winter reliability market enhancements, the ICAP demand curve reset process, reliability-based attribute capacity prices, and a capacity redesign. So again, all kind of things to make the capacity market function more efficiently, and also things that will solve for, some of the reliability concerns that come up in the modeling, in the next 5 years, just given some of the dynamics that I discussed before. And so overall, we feel that that's going to support prices in the near term. If we talk about the costs that are associated with the CES, the Clean Energy Standard, and the CLCPA, the Climate Leadership and Community Protection Act, we can see that there's basically a couple of actions through the state as part of these two programs, really geared towards helping the state meet some of its clean energy objectives. Those are listed out here. They include 40% reduction in greenhouse gases, et cetera. I'm not going to read through all of those. But in order to support these goals, some new energy costs have been and may continue to be added as these programs like the CES and CLCPA are implemented. Some of these, which have been existing obligations for the last few years, are things like, renewable energy certificates, zero emission credits, or the ZECs, and some of the public policy transmission projects. This year, for 2026, there's also 2 new charges that will be implemented as part of these programs, and that's the Tier 4 RECs, which is RECs that are deliverable specifically to New York City, and even though those are deliverable to New York City, that obligation is shared or socialized across the state. And then the CLCPA facilities charge. There's some other charges here that are expected in coming years. You can see overall, this is about 6% of costs. I don't want to go into like a deep dive on all of these components because, we're kind of short on time to do that today, but I do have a slide included for each of those in the presentation, which you'll have as a takeaway. I just wanted to kind of look at very broadly here what's expected with these costs in coming years. So the New York Department of Public Service recently filed their second annual report, which essentially kind of looks at how these program and cost recoveries are working and what the forecast looks like out through 2029. And so it's a little bit hard to see, but in the blue bars, that's representing the distribution charges that I mentioned earlier. The green here is looking at the supply portion. And so you can kind of see over the course of the next few years how these costs are expected to increase year over year, in support of some of those goals. And the last thing that I'll just say on this note is, as affordability becomes a concern alongside reliability in the state, I think there are a lot of discussions and actions underway amongst stakeholders in New York to look at ways to meet the state's climate goals while also keeping things affordable for consumers in New York State. And so, the government, the New York ISO, and various kind of counterparties are looking at ways, to keep these costs lower, as, like I said, we've continued to kind of see them move higher year over year, in addition to some of the energy costs as well. So like I mentioned, there's a couple of slides here that do a deeper dive into what some of those costs are. So the first here is, where the existing obligations. The second slide is looking at new obligations for this year. So the Tier 4 RECs and CLCPA charges I mentioned. And then the final slide looks at some future cost obligations. But for time's sake, I'm gonna move forward, and then, if there's questions around this, we can come back to it. And the final piece here I just wanted to touch on was transmission project costs. So historically, transmission costs fall on the distribution side of things, but in the last few years, some of the projects that are associated with New York's public policy transmission actually have fallen on the supply side of the invoice. So a few of those projects are shown here. Two of which came in service over the last few years. So in yellow on the far left-hand side in this map, you can see the Western New York Transmission Project, and then also the AC Transmission Project, which you can see in the yellow on the right-hand side of that map. Additionally, there's a couple of planned transmission projects that are underway and expected in service later this year and then out through 2030. These costs, kind of are implemented as they come online. Developers share those costs with LSEs once a year, but they aren't known beyond the current year. And they're pretty immaterial. I think if we think back to that pie chart, it's about 1% to 2% for upstate New York customers. So not super significant in terms of impact. But one of the things that make these charges a little bit more, or these projects, I should say, a little bit more impactful, is their ability to shift congestion patterns in the state. So again, just to kind of think about it, these projects are aimed at alleviating congestion. There's a lot of lower cost, base load resources in upstate New York, both through the hydro and nuclear available. And over the years, there's been a lot of congestion in upstate. And so these projects are aimed at alleviating some of that congestion, making it easier to flow power, from upstate to downstate. And so one of the things that's affected about the energy prices themselves, so that bigger portion of the pie chart, is that, historically in upstate New York, prices have been at a sizable discount, well below kind of prices in downstate New York. And that fundamental still exists. But as we've seen some, improvement in congestion in the middle of the state, we've actually seen a little bit of a shrink between, the difference between prices upstate and downstate. And so these two charts are looking at forward calendar strips, so forward prices. The charts on the left-hand side are looking at Zone C, so central New York and upstate. The charts on the right are looking at Zone J, so, New York City. And with all the fundamentals that I talked about being the same, and impacting all of New York State, you can see that downstate prices have not moved up to the same extent as upstate prices this year. And really the reason behind that is, the implementation of these transmission projects, which are working as anticipated, improving congestion, but that's actually been more supportive for upstate prices, and put a little bit of downside in downstate prices. And that's why you see a little bit of a difference between, the trends there, even given the fact that, gas supply and demand, all those other fundamentals are sort of working the same. If we look at index prices, you can see a similar trend. So again, the last slide was looking at forward prices. This slide looking at index prices or spot prices. This is where a couple of things you can see. Again, we're looking at zone C here on the left-hand side, and on the right-hand side, I'm actually showing zone F, which is, capital region up near Albany. Two things should stand out here. One, the volatility that you see in these prices month over month. This is going back to 2010 and is as current as March of this year. And so you can see, definitely more volatility in peak seasons like summer and winter. You can definitely see the spikes in prices into the triple digits this past January and February, driven by some of that colder weather that we talked about. You can also see, a little bit of a bigger impact in terms of higher pricing in the last year or two, having a bigger impact on, kind of zone C, zone A, your western upstate parts of the state, than some of the zones that benefited more from the transmission projects. And again, just like the year over year change, the change versus the 5-year average, we're seeing prices, between 100 and 189% higher than the 5-year average. The year over year change here is actually comparing 2025 and 2026. So, January, 79% higher in zone C, 37% higher in zone F. But if you compared that to this January versus January of 2024, it's closer to like 250%. So again, we've really seen kind of costs move up in the last year, driven by all these fundamentals, driven by the colder, risks and constrained system this past season. And our expectations, given everything that I just talked about, is that we'll continue to kind of see both the volatility as well as price support, given all of the factors that are impacting prices right now. So I'll kind of wrap it up by just showing, a high level, some of the strategic takeaways, and then I'll turn it over to Dan, who will talk a little bit more about, purchasing strategy. But we continue to see this tighter supply-demand balance. It's been supportive of prices in 2025. A colder winter for the East Coast supported prices in New York so far this year. We continue to view natural gas and electric demand as growing in the coming months and years, and the Middle East conflict could elevate that demand further. This fluidity around state as well as federal policy adds more uncertainty to the already volatile market, and it certainly has an impact on the timing around transmission projects and new generation build in the state, and that's going to weigh on the price trajectory going forward as well. And then, additionally, with everything going on in the Middle East, if that continues, that can have some strong support for winter prices in the state. And actually what this chart shows is the change in pricing over the last week, month, and year for a 1-year contract, a 2-year contract, and then just the winter strip. So this coming, December, January, and February. And just in the last month, winter prices have moved up about 25%. So that just shows, how much there is a risk associated with kind of what's going on in the Middle East and the global picture. And it really just shows generally, how volatile things have been, how much things are moving up, and why it's so important to have, the budget certainty, because, and I'm just gonna click back real quickly, again, you have these price spikes like what we saw in January or February this year, where energy prices, just the energy prices, were upwards of $175, $180, $185. That can have a significant impact to the budget. And so again, putting some contracts in place taking those contracts longer term where you have the opportunity to do that, given all of, you know, the fundamentals and where we kind of view pricing over the next few years, I think is going to be very important in terms of budget certainty. And with that, I will turn it over to Dan.
Thank you, Britt. That was fantastic. You know, us energy people can listen to Britt all day, and we're consistently learning new information. And so much appreciate your efforts, and thank you so much. So I just wanted to relate. So last week, I had the opportunity to attend the New York State Association of Counties legislative meeting in Albany, and got to work around the mega booth. While being there, I got to engage with a lot of existing county-based customers and municipalities coming up and once again asking questions. And it seems like a lot of our existing base, maybe many of the people on this call, they currently have a fixed price in place, and most of those expire in October because of the way the last public bid worked. So they didn't necessarily feel these big impacts of what we just went through. But what they are feeling is the current renewal pricing they're getting is considerably higher than where they currently are. And that's causing a lot of concern. Looking at the slides that you were able just to present, you know, that phenomenal slide that had a New York Electric demand growth is outpacing supply. The new clean energy recovery components, what those price impacts are, 24, 25, and going forward. The growing impact of clean energy surcharges and the CLCPA compliance. More of our natural gas is being exported, so we won't have that necessarily for our domestic use. The growth of the AI and the data centers. Obviously, people that have been able to attend this are getting a better feeling of why their outgoing prices or their current availability for renewal prices are higher than what they have currently. But, you know, having not gone through what most of those index customers did, it was definitely a question that keeps coming up. And I'm glad that you were able to really touch upon just a few of the factors leading to why these future prices are higher than the past prices. But within that same question, there's a really interesting, I want to call it rare occurrence right now. We're able to actually show customers some very good fixed prices that are in that 2028, 2030 time frame. And you know, we refer to that as backwardation, where customers are actually able to get into what looks to me a very good energy buy, which really doesn't really seem to make a lot of sense. And I guess that's why it's a rare occurrence, being even what we just learned today with all of these new costs coming in. Could you help me explain, or is there, I've searched for it, but what do you think might be some of the reasons that customers today can actually buy into a pretty good electric price, but comparably in those outer years?
Yeah, so I'll assume that's directed at me, Dan. And I did just flip back to, so this is the charts that are actually showing, you know, what Dan mentions here. You can see for zone C, which is on the left-hand side, how some of the years like calendar 28, 29, 2030 are actually, you know, trading at a discount to nearer terms. And there's a couple of reasons for that, but I'll say predominantly in New York, there's a liquidity window of about 2 years. And so some other areas like PJM, even NYMEX, you'll see more liquidity further out in the curve, which means like those years are trading a lot more frequently. But that's not the case in New York, which again is a big benefit to customers when there's bullish fundamentals or expectations for prices to move higher, because the market can be slow to catch up to what the fundamentals are for longer term years. So I think we're seeing a little bit of that right here where, there's just not a ton of liquidity right now in 2029 and 2030. And that's a benefit to customers because Constellation's willing to hedge that. And the market's been kind of slow to pick up on some of those fundamentals because of the liquidity windows. And then also, just things like near-term risks tend to affect like the prompt year or the closest coming year more quickly. So for example, the price exposure that we saw this winter and the higher prices that we saw this January and February, those didn't exist 2 years ago. And we had overall kind of warmer wet weather and warmer winters the last 10 years. Well, now of a sudden you see this like cold shot that had an impact on prices that starts to push up like next year's winter prices. And so that kind of contributes to that spread too between near-term and long-term prices. So again, being able to take advantage of those longer terms, 2029, 2030, where the market's still undervaluing things because of the liquidity window, that can be a really good strategy just to kind of smooth your overall costs.
Oh, excellent.
Dan,
Yeah, that's
Dan,
a great.
it's Mark here. Dan, do you mind if I jump in? Britt, I got most of what you said here, but could you define liquidity window in terms of your answer? I got a little fuzzy on that myself, and perhaps some of our attendees did as well.
Sure. Yeah, no problem. So the way that these like markets work in terms of hedging, like forward hedging, right, is they kind of trade by calendar year, they trade by like peak. There's a few different tranches in which they trade. In New York, and especially for some of the, less liquid zones, and I'll kind of define that as I'm talking about it, you don't see those trades happening as frequently as you do longer term as you do in the near term. So for instance, every day we kind of update our price curves. That means that our pricing that we sent yesterday is no longer good because the market moves. Well, the majority of those moves, the majority of the buying and selling, like in the market, in ICE, happens in the near term in New York. So like the next 2 to 3-ish years, that's really where you see the most daily or weekly like trading or hedging happening in the marketplace. You don't see as much beyond that. So in like 2029 and 2030, and it's really that trading that kind of moves the market prices, right? Like where are people willing to buy or sell power in the future? And so that means it can be kind of slower to catch up to the fundamentals because you're not seeing a lot of sales in the market. Again, Constellation is willing to sell out through 2030 and hedge that. And so sometimes you can take advantage of that, like that. The fact that there's less liquidity, less buying and selling that far out in advance kind of keeps those prices lower. Whereas near-term trading, with everything going on in the market right now, people who have been trying to hedge for 2027, they're paying more. That's why you see that red line move up. The market prices are moving up. And so that's kind of what defines liquidity. And again, the more liquid kind of hubs in New York are zone A, G, and J, kind of between their trades even less frequently. And then again, New York in general just has like a shorter liquidity window or shorter amount of, window for buying and selling than like an area like PJM West Hub or something. And so, again, that can be advantageous because those longer term curves kind of can sit a little bit flatter than they should for a longer period of time.
Thank you very much for that explanation. Appreciate it.
Excellent. And that actually leads me to the next common question that all of us that are talking to our municipal customers have. And as I mentioned, so many of them have October or at least this year renewals that they have to get done, and they are looking at higher electric costs at the same time everybody's dealing with budget issues. Timing. So many people, as we're having these discussions with municipalities, and I heard it a lot last week, of, I'm just not comfortable here in March to go ahead and commit to a renewal fixed price that's higher than my existing fixed price. I think we're going to try to wait it out and see if the market comes back closer to where we are today. And so obviously, I think we've already learned where that might not be the best strategy, but nobody can perfectly tell the future. But I guess one advice that I just wanted to get across to customers, and I think we've picked this up and it's been reinforced today, that especially if you're looking for some long-term budget stability, now is a good time to bring this in front of your committees or your boards that can make that decision. That waiting, there's probably a pretty decent chance that those outer year pricings won't have the liquidity that's currently available today, and we might be missing out on a longer term value position, even if you just wait the next 4, 5, 6 months. But I just wanted to get that across. If anybody's got any different thoughts on that, I just you know, I don't want to sound self-serving to customers. You want to say, oh, you should do this today, but I have to be honest, at times where people say, when is the best time to have me done this? And so far, when I'm looking at the forward prices, I'm having to say last month or the month before, or even October 25. But I think this presentation today reinforced, gave us some data behind why it's not necessarily prudent to wait and hope. That you might want to jump on a value while it's right in front of you.
Yeah, and Dan, I just would add one thing, because I probably didn't hone in on this enough. Like, if you look down in the chart here, so where it says power strips, Cal C, Val year, Cal 27, 28, 29, you can see right now 29 and 30 for zone C. Cal 29 is trading at 56.31. Cal C 30 is trading at 55.32. This is in dollars per megawatt hours. But to put that in perspective, in 2025, the average index price was 56.31. Right now, so far for 2026, we're at 112.92. So those are comparable numbers. One's looking at the forward energy price, one's looking at historic energy prices. But so when you can buy a term for less than what, you know, last year's actual price was, that's 5 years out, you know, Cal 29 matches last year's price. Cal 30 is at $1 discount. Like, that's a pretty significant you know, story. So I just wanted to point that out to put it in perspective and kind of draw a tie between like what those two charts are representative of.
Yes, excellent point. And just for a clarification for our audience, when we're looking at these LBMTP prices, or we're looking at these prices that you're seeing where it says like 59, 54, that is an energy only price. So you as a customer, when you're looking at getting your fixed price through the mega program, we're not just including the energy component, we're including all of those components that it takes to actually get you your actual energy that will show up on your invoice. And so within that, you are paying for those capacities, those ancillaries, these transmission projects. And so just not to be confused when we give you a fixed price and it's saying 9 cents, 10 cents, unfortunately, and then you say, well, I saw on that presentation it was 5.6, but that's just a realization of the energy component in New York is actually becoming smaller. Where on this slide that Britt has up right now, you see it's 73% of historical costs has traditionally been the energy component, and that does change by zone. That number over time has actually been shrinking because these other components, those components that we reviewed today that have associated with the clean energy surcharges, the capacity component that's becoming more expensive in New York, the energy component has actually been such a good price that it's taking up less of your total bill, which is another thing that my business customers are jumping on and buying long-term fixed energy deals. And I think that this presentation would help our government municipal customers realize that it's an opportunity for them too, to look at things. And Mark, if you could just jump in for a second and mention how Mega realized this and that proactive movement that your board took to try to help these municipalities take advantage of this.
Yes, thank you, Dan. And I want to remind our audience that we have a couple of minutes left in this hour program. So if you have any questions, please submit them as soon as you can. And then we have some experts on the line who can answer those. Also, if you have questions after this presentation, feel free to send them to me, to Dan, or to Britt, or send them to me and I will get them answered by Dan or Britt. So thank you. And thank you, Dan. Yes, our Mega Board of Directors has recently extended the most recent contract that we have with Constellation for 1 year. So that is through October of 2030, so that our members can take advantage of these out-year prices. Again, as Dan and Britt have both mentioned, these out-year prices normally are not usually cheaper than what you paid 2 years ago, or as on a comparable rate like they are right now. So we wanted to make sure that our members had that opportunity to take advantage of those out-year prices. So that's why the board extended that. And with that said, I want to also recognize on our board chairman, Mark Taylor, is with us today, and our board vice chair, Shelley Stein. So thank you both for joining us today. I do have a question, Dan, but let me go back to you real quick, and then I will, oh, we do. So how do we find out what energy zone we are in? Great question.
Yeah, it's simply once we know your location, it will take me a couple seconds to tell you what zone you're in. Of course, don't put me on the.
How can an individual who might be on the call figure out what zone they're in? Can they go on the NYISO website, the Department of Public Service? How can they find out what zone they're in?
Sure. Well, we can send you, if you want to forward it to the Mega members, we can send you a zonal map. So basically like that, the map that you see that's up on the screen, that's got the center portion highlighted right now. So that's like highlighting zone C. But I can send you that same map with each of those zones labeled, so people know generally what zone they're in.
That's a great idea. Please do so, and we will send that out in our energy update that will be coming out tomorrow. And then can you add me? Yes, we will definitely add you to the list. Leroy, New York. So that is in Genesee County. Dan, do you know what zone that is?
Yeah, that's probably zone B.
Okay, great. And we will include that in Mega's next energy update. It is 10:59. I'd like to turn it back to Britt for any closing comments here before we tie up this webinar.
I don't have too much to add other than I will just really quickly note in terms of the zonal price difference. So zone C, which I used in a lot of the graphics, is actually a really good benchmark for some of the other upstate zones. So if you're in zone A, B, C, D, E, the price charts and trajectory will be very similar to those that I showed for zone C. And so I just wanted to kind of point that out there. And then, like I said, lastly, I just really appreciate the time today. I'm always available and happy to help answer any questions that you might have. You know, even as a follow-up, you can see my contact information here, or you can reach me through Dan. You know, and thanks again for the opportunity to speak today. I appreciate it.
Thank you, Britt, and thank you, Dan. On behalf of the New York State Association of Counties and the Municipal Electric and Gas Alliance, we thank our partners at Constellation, who are experts in the field of energy, and they are always willing and able to lend their expertise to make us all a little bit smarter about the energy market. And that is why we rely on them so much. Thank you very much to Constellation. Thank you to Mega, and thank you to NYISAC and all of the NYISAC members and Mega members who joined this webinar today. Have a great day.